You don't lose money when the storm hits. You lose it when you ignore the wind a year before. Today we read the wind. By the end, you'll see 5 shifts already in motion. They will touch prices. They will shape jobs. They will bend the value of assets. And you will know how to stack the odds in your favor without chasing headlines. The first shift is the quiet reshuffle inside the Federal Reserve. Most people never notice when names change in that building. But those names tilt the cost of money for 300 million people. Jerome Powell's term ends in 2026. The White House is pushing for new members who want cheaper money. A small table of people you never voted for will soon decide your mortgage bill, your car loan, your salary raise. Think of a bakery owner in Ohio. She believes interest rates belong to Wall Street. Then her credit line renews, the payment jumps. She must choose between raising the price of muffins or cutting a worker's hours. That is the Fed in her kitchen. Two paths sit on the table. One path is looser money. Debt gets cheaper. Assets rise. Inflation risk grows in the shadows. The other path is stubborn inflation. Cuts start, cuts stop, markets swing, wages crawl sideways. What can you do with this? Map your rate exposure in 10 minutes. Look at your mortgage reset date, your variable loans, your business line of credit, your student debt. Write them down on a single sheet. If you carry debt, try to fix the rate before a broad cut cycle pushes prices higher. If you invest, rank your watch list by who gains most from lower discount rates. Quality growth with clean cash flow, small caps with strong balance sheets, real estate with rent coverage that survives a squeeze. The surprise is not the first rate cut. The surprise is how cheap money raises the cost of living a year later. The second shift hides in the way interest has become the government's fastest growing expense. Lower rates can shrink that bill, but if new borrowing balloons at the same time, the relief is gone. The Fed meets on September 17th, 2025. Everyone will stare at the cut. Few will notice the chain reaction it sets off. Here is the rhythm: cut, refinance, rush, asset lift, delayed price creep. Picture a young couple, they refinance, their monthly payment drops, they have more cash flow, they walk into a bidding war for the next house. Prices climb, the very savings they hoped for vanish into higher costs. How do you prepare? Build a barbell between short cash for flexibility and selective long duration for growth. Hold some dividend growers, high yield traps. Look for companies whose payouts grow because free cash flow grows. Check real estate not by glossy pitch decks, but by cap rate spreads against funding costs. Stress test rent growth at half your optimistic guess. Cheaper money does not mean cheaper life. It often means the opposite. Buy income streams instead of chasing headlines. The third shift is global. Pressure on the dollar. Talk of countries trading less in dollars, BRICS noise, gold-backed rumors. The same story that made gold run after 2008, fade after 2012, wake up again around 2020. Dollar share moves slowly. Contracts don't flip overnight, but small moves matter if oil shifts part of its trade currency. If reserves shuffle 5%, if sanctions speed up alternatives, trust bends and capital looks for backup. Your hedge does not need panic. It needs a menu. A slice of gold or gold royalties. A small basket of non-dollar assets. If your life is fully dollar-based, businesses with global pricing power that can swap suppliers or pass costs. Think of a Vietnamese American importer in 2020. He used forward contracts to lock rates while headlines screamed he slept. That is what calm hedging looks like. You do not need to predict the world currency. You only need to keep your household from being a single bet. The fourth shift is political. Tariffs announced in 2025 shook markets. They paused, then returned in renegotiated form. Tariffs are taxes in disguise. At the same time, a new bill cuts other taxes. Spending stays high. Borrowing fills the gap. Inflation risk builds again. A tariff of 10% rarely shows up as 10% on the shelf. Currency shifts. Suppliers absorb, margins split. It often lands as 3 to 5% for the consumer. Still, it matters. Investors can protect themselves by owning pricing power. Look for repeat buys, high switching costs. Mission-critical parts. Tariff-neutral businesses thrive too. Domestic inputs. Software-heavy models. Subscriptions sticky enough to cross borders untouched. If you run a small business, negotiate supplier terms before tariffs hit. Stagger your reorder cycles, protect margin while others scramble, and think of your taxes. Fill your advantage buckets before new rules swing. If self-employed, lock in deductions with clean records now. Prices rise quietly. Your advantage is noticing which line item moved first. Better to own the seller than the shelf. The fifth shift is stress. National debt sits near 37 trillion. Interest is the fastest growing outlay. Consumers crack at the edges. Auto delinquencies rise. Card delinquencies rise. Banks tighten lending standards again in 2025. That sign usually precedes slower growth. Households need a 3-alarm system. Alarm 1. Your minimum payments cross 25% of take-home pay. Alarm 2. Your emergency fund cannot cover 2 credit card cycles. Alarm 3. Job relies on rate-sensitive demand. If an alarm rings, move fast. Refinance high-rate balances into fixed terms with an exit plan. Build a 3-tier cash stack, bill buffer, shock fund, dry powder for bargains. If you hire, shift to revenue sharing where possible to protect cash. Picture a rideshare driver in a cold winter. He planned a 6-month cash hill. When demand slowed, his car avoided repossession. He still drove in spring. Stress never asks permission. It only checks if you left room in the... Millionaires know the loudest headlines rarely matter to their long game. They build wealth with habits so quiet they almost look boring. Start with 2 lists. List A is purchases that fall in value. List B is purchases that pay you. Look at both lists once a week. Move 1 item from A to B each month. This rhythm compounds more than any forecast. Build what I call the autopilot delta. Every time income rises, every time a client pays, set an automatic increase to your investments. Not a decision, just a rule. Money flows in while noise fades. Protect your ability to say no. Never take a deal that locks you into one path with no exit. Optionality is a shield. It lets you choose later when others are trapped. Forget net worth charts. Count years of expenses you can cover without selling stock in a crash. That number measures real freedom. Wealth grows in silence. Noise comes in headlines. Now let's move into a 3-step playbook you can use over the next 90 days. This is the passive pathway. In the first 30 days, map every debt and its rate, mark reset dates, rename your savings buckets, bills, shocks, deals, build a watch list of 10 businesses, 3 funds, 1 real asset. In 60 days, cut 1 major expense, send the difference automatically into investments, freeze your credit file, block lifestyle creep, start one-side income stream to at least $200 a month. In 90 days, rebalance once with rules you can keep. During a dip, write a 1-page plan with if-then statements for layoffs, for rate spikes, for tariff surprises, wealth rewards routines, more than predictions. Now look at some quick case stories. Sarah was a teacher drowning in minimum payments. She used a ladder and lock sequence. 18 months later, she was debt-free. Omar owned a cafe. When tariffs hit beans and supplies, he swapped vendors. He upsold high-margin drinks. He kept his margin intact. May was an engineer. Her parents had all savings in a single bank product. She shifted to a currency-aware portfolio. They avoided hidden losses. When rates swung, Jamal was a contractor. Suppliers threatened to cut credit during a lending freeze. He had pre-negotiated terms. Deposits from clients funded materials. He survived when others folded. If they could design around storms, so can you. Questions often rise. Right here. Should you wait for cuts to buy a home? Cuts lower payments, but they can also raise prices. You cannot control both. Better to buy when your personal cash flow can carry the loan with a buffer. Does gold make sense if you already own stocks? Gold is not for growth. It is for backup. A slice protects against the unknown. Too much stalls your compounding. What if rates never fall as much as promised? Keep flexible assets. Hold cash for opportunity. Build businesses that thrive without cheap money. How do you invest if you start with only $100 a month? Automate. Buy broad funds. Ignore timing. The habit matters more than the amount in the first years. You do not need perfect timing. You need a plan you will keep. Here is your 1-minute checklist. Freeze 1 expense. Send the savings into auto invest. Fix 1 rate. Pay one card to zero, add one hedge, learn one income skill, write one sentence for bad days. I buy income. I ignore noise. If you find these steps clear, like the video, share it so others can prepare. Comment with the shift you see as most urgent. Subscribe for more quiet steps that grow into lasting wealth. Feel free to explore the other videos on this channel for more tools and stories. And I will see you in the next video on the passive path.